Primary market refers to the market where securities are issued for the first time to outside investors. It is also called a new issue market. Promoters are the original stakeholders of the company. This process of raising capital from public investors outside the promoter group is called going public. Functions of primary markets. Primary markets help promoters open up their sources of funding to a larger group of investors. As the securities are issued to the public, the price is determined by forces of demand and supply. Some securities, like government securities issued by RBI, undergo an auction process ensuring fair price of security. Transition from a private to a public company also involves additional disclosures to meet higher standards of transparency. As ownership of the company broadens, independent directors are nominated to boards. Professional managers are brought in to look after the investor interest of a large and diverse set of shareholders. This also opens up the company to evaluation and scrutiny. Exit options through primary markets issued at a fair value work as an incentive to promoters and early investors. Primary markets also increase liquidity of securities and brings companies under regulatory provision and supervision. There are a wide range of issuers in the market who raise both debt and equity from these markets. When a PSU offers a portion of the government share, it is called disinvestment. Private sector companies also raise funds from international markets. Government, financial institutions, and mutual funds are other issuers in the market. Bonds issued by the government carry government guarantee. Primary issues include issues to the general public called public issue. At times, debt or equity is offloaded to a select group of investors, like high net worth individuals, institutions, or venture capitalists by the promoters. This is called private placement. We will take up preferential issue and other type of issues in subsequent slides. Investors to these issues can be either retail investors or institutions. Here is a list of regulators of the primary market and the various acts that regulate these markets. Make a note of these. First public offer of shares is called initial public offering or IPO, while subsequent offer is called follow-on public offer. Two types of IPOs are fresh issue of share and offer for sale. In a fresh issue, new shares are issued. As we can see in this example, new issue of 1000 shares increases share capital from 5000 to 6000. Number of shares that promoters are holding stay the same, but percentage holding comes down. In an offer for sale, issue is done from existing shareholding. As you can see in the example, 1000 shares are issued from the already issued capital. There is no change in the issued capital. This money goes to the promoters and not the company.